Good afternoon, everyone. Welcome to our October 2023 monthly market exchange. We thank you for joining us today. This is Jeff Hibbeler along with Randy Farina. Before we get started, I would like to remind you to please send in any questions or comments to info@essentialwealth.com. We will address these before the end of today's call. So in the month since our last call, equities broadly are off about 5%, although equity markets are still solidly positive on the year after their run over the first several months of 2023. Bond yields, they've continued their move higher, more so in longer maturities on the yield curve. And this morning we saw the 10-year benchmark just over 475. Markets have been digesting the most recent Fed decision and the implications of their expectation for maintaining a more restrictive policy for longer. We're going to dig into the Fed and economic outlook in a bit, but first we wanted to get into AI, our first topic, particularly given that it's dominated equity markets this year and driving some big price moves in them. So Randy, good afternoon. Welcome you back after your recent travels. You want to kick us off and touch on market expectations around AI going forward?
Sure. Glad to be back, Jeff. This is actually my first call since June. Pete filled in for me in September, and we did not have one in July because we had the semi-annual webinar, and then we skipped August because of the semi-annual webinar. So since June, the last call, early June, the markets are probably flat. Now, they went straight up in June and July, and a lot of that was driven by NVIDIA's results in late May. Now, NVIDIA is a GPU graphics processing unit. So what the heck is that? Think of Intel, which makes a CPU. A GPU is just a faster way to process. It's just processing power of a computer. So what is AI? A lot of, as you said, the market theme in 2023 has been dominated by AI. We always get these themes in the markets. In 2020, it was the COVID work at home theme. In 2021, it was the, recovery theme, the revenge travel, revenge services, or, we're all locked down for a while. We wanted to get out and live again. And those themes dominate, market cycles. And I've, again, as many of you know, joined this call, over the years, I've been investing since late 99. I got my start as a tech analyst in late 99. And to me, this, of all the, market themes and cycles, the AI to me is the most, has a strong parallel to the .com market. And I'll get into that in a minute, but it's really like walking down memory lane for me in a lot of these market reactions to the AI theme. So AI in general, it's just trying to use data. Everything we do creates data. What we watch, people are collecting data on us. Every Google website, every website you go to, every travel booking you make, every hotel you stay at, someone's collecting data on you. Every purchase we make, whether it's online or at the store, that data is collected and it can be analyzed. And at the end of the day, a company is trying to generate more revenue by having a process in place that allows them to have better sales productivity and better manufacturing productivity if they're a manufacturer. So AI, in the long run, forget its society impacts and all that. That's not what I'm here to talk about. It's more market expectations and implications. Its actual usage will be to create more revenues for companies or to lower operating costs or to improve productivity. That's what AI will be used for. And at the end of the day, it's the powering of the data analysis that needs to happen is done by, a few companies that create a GPU. Today it's NVIDIA and AMD. Now, will other companies come along and challenge NVIDIA and AMD? Maybe. Intel's been trying to create a GPU forever and they've struggled. So the whole, again, the market theme of AI really kicked off when NVIDIA had results on their May earnings that, revenue expectations were supposed to be around 8 billion, and they said next quarters would be 12 billion. And so, that incremental $4 billion just set the market on fire about the potential of AI and how it was going to transform companies and transform markets and generate a lot of new revenue. And it may. The problem is it's still so early in its adoption and its usage that there's really not a lot of use cases yet by businesses that are going to generate additional revenue off it. So I think what's happening right now is that a lot of companies are going to be trialing how they can use more of the data they can collect now that they can have the ability to maybe process it. And again, at the end of the day, when you're analyzing big data, you're really just looking for patterns and trying to find things that it can help explain an outcome better and put you on a path to get to that outcome quicker. Again, whether it's manufacturing or trying to capture additional sales. So there needs to be a use case for a company to deploy a lot of AI services. And right now you can go to Microsoft, you can go to Amazon as a company, and you can go to even Oracle, and you can get, some AI cloud services. You'll pay for it. And that's why those companies, again, Microsoft, AWS, which is Amazon, and Oracle, I mentioned, they're using NVIDIA's chips to help process all this data. So again, just giving a little bit of background on what AI is and how it's being implemented. So that's where we're at today. I think the market has correctly viewed AI as a new technology that will help productivity and enhance sales, and can be used by all companies and individuals, even ChatGPT and things of that nature. It helps you as an individual or business, mundane tasks and labor-intensive tasks. If you can kind of automate those more than they are today, the better you save, the more you can deploy resources and expenses into other areas of the business, and you can remove some cost from that. So there's definitely a use for it. I think similar to 2000, here's where I get into my parallel with .com.
I was just going to ask you that, Randy.
Yep. So I have to give the long preamble before I get into that, Joe. So similar to .com, the internet was new. No one emailed pre-99, 98. No one had a cell phone or a smartphone. We might have had some cell phones then, but you didn't text on it. You didn't take pictures on it. You just used it to call home, when you were away from a phone. So the uses of it increased over time as well. But what happened was the market, rightly did identify a change in an opportunity for, a revolutionary technology or, evolutionary, however you want to describe it. It's something that was new. The problem is the market usually overestimates the time that something takes to get implemented and used and digested by companies and individuals over time. So the market bid up, meaning they priced a lot of stocks very high in 2000, extremely high levels. The market was at its most extreme. If you look at any charts on PE, on price to book, price to cash flow, any kind of metrics, the market was the most expensive back in 99. That was because it was trying to price in what the potential of the internet was in too short of a period of time. Now, what ended up happening was over the next decade plus, the use cases for the internet, and then the smartphone got created in 07 by Apple with the first iPhone, all the things that could use the internet, use the technology, individuals comfortable with buying online. It just, the whole ecosystem of it took a decade plus to develop. And a lot of stocks that peaked in 2000, to now tie it back to market implications and why we as investors, you know, at Essential and are always concerned about cash flows and valuations. And we mention those words a lot. And it's because of this. If I look at a lot of the winners that were perceived winners back in 2000, a lot of them don't even exist anymore, to be honest with you. Nortel, Lucent, Corning, they were building the backbone of the internet. They're gone. I mean, Corning is still around, but a shell of its former stock price. Lucent and Nortel both went bankrupt. There was another company, JDS Uniphase, went bankrupt. Sun Microsystems, they were selling servers that the internet would be powered by. They got bought by IBM, 90% below the peak in 2000. Cisco is still below. Again, they build the backbone of the internet with routers. They're still below their 2000 peak 23 years later. Microsoft took 17 years to get back to its 2000 peak. Qualcomm took 19 years to get back to its 2000 peak. So the market can overvalue a generational change in technology because people get too enthusiastic and they sometimes don't step back and think about, well, what does it mean for the cash flows and the earnings over the next decade? Are we overpricing that into the market? So again, bring it back. Didn't mean to go on a 12-minute ramble, but to bring it back to NVIDIA, it's gone from 150 to 450 to 500 in the last 6 months. Why is that? And again, they are a phenomenal company. They make a product that very few, if only one other company can replicate, and they're not even as good. So it makes a product that is unique, and they have dominant market share. Yet I think the market is overpricing what they can deliver over the next 3 to 5 years, based on there's still not a lot of use cases. There's still not a significant revenue or sales or productivity enhancement that can be adopted yet by companies that are going to use AI. It's still in the early innings. And I think, again, the market has exploded its expectations and its valuations on some of these names. And I just think it's too early to have any certainty on how the cash flows will develop over the next 3 to 5 years. And we don't own NVIDIA. If it gets to a price that's cheap enough, we will. But it's not there yet. We don't own a lot of the other names that are tied to it. And a lot of names that we've been trimming lately, Oracle, for instance, have benefited from the AI theme. Even Adobe, we've trimmed. A lot of those names have benefited from being part of the AI ecosystems. But again, we think risk reward skew is not favorable in some of the names, and it's overreacted in a lot of the names. I went on way too long, Jeff. I'm sorry.
No, it's good background. You know, it kind of along the .com theme. You know, one thing I was thinking this similar thing to you on that, but you know, I think something you were touching on is kind of the use case, and you know, the excitement builds, but then it's kind of how is that implemented across corporate America? How are they able to leverage that? And that's where, you know, you kind of saw the power of the internet and how it evolved into the, you know, it was the initial like tech company build out, tech companies that were, you know, producing the infrastructure, but it was, you know, then how did that ripple across corporate America?
Right.
And add to productivity.
Is always longer.
Yeah.
The market expectation or the market valuations, you know, pull in that adoption curve as if it's going to be in a year or two, when it's really more like a decade. So that is the parallel. We'll know more in 12 to 24 months, you know, but that's my base case expectations, that it is a real technology. It is real in its productivity potential and its enhancements for sales and revenues, but the adoption will be much longer, and ability of companies to leverage it will take way longer than we think.
You know, kind of also just anecdotally, Randy, you know, when you're evaluating companies, how much, clearly the tech companies are going to be talking a lot about it. How about companies outside the tech space? Are they, you know, how much are they, you know, discussing it and focusing on it?
As you know, Jeff, this industry is all about buzzwords. So it is the buzzword that a lot of companies will use on their conference calls to talk about how excited they are for the future in terms of revenues because they're now implementing AI. It's, you know, the optimism, it's the what everyone wants to hear at the moment, but I don't think it's actually impacting anything in terms of additional revenues, margin enhancement, productivity. It's still too early for companies actually benefit from it. You have first the tech guys have to figure out how to use it, right? Then they have to explain it to the, you know, the guys in the office like us that we're not tech savvy per se in terms of using apps and things like that. And then it's got to permeate through the organization. Now, we've been, you know, part of investment teams and banks and other organizations in our career. So maybe we're in a slower moving ecosystem. But, you know, just think how long it takes for even just a regular new application to get used across the firm. It's years, not weeks or months. So yes, every company is touting it as the future of how they're going to grow more and cut costs and have better margin. But at the moment, it's just, you know, optimism versus reality.
Okay. Thank you for the rundown on that. I guess, you know, it's most likely probably going to be a topic we're talking about in the future, but it's going to be an evolutionary process. Yeah,
and now I know we're going to delve into the Fed and markets, but as you mentioned earlier, the markets, I think, you know, you mentioned down 8% in Q3, but year to date still up 10% plus. But that's really only the S&P and the NASDAQ, and that's really been driven by the AI. Small caps are, you know, negative. International companies are up a couple percent. You know, value stocks are up a couple percent. The market really has been bifurcated by two sectors, tech and comm, which comm includes Google, Meta, and some of those names. Remember, they got hit the most last year, but they're up a lot this year based on the AI theme. So that has dragged, or that right word isn't dragged, that has the underneath the market, a lot of stocks are down or negative. The overall S&P is being, you know, propped up isn't the right word either, but it's being helped significantly by just a handful of stocks.
Yeah, that's something we've been talking about a lot lately. Well, really the last few months on our team calls, kind of the market breadth of it. So,
right.
Well, yeah,
let's gets into, again, you're going to go into the Fed and interest rates and all that, but the underlying breadth of the market is probably, you know, negative or not great because of, as you mentioned, rates have now hit a 15-year high on the 10-year. The Fed has continued to potentially have another rate increase in its purview. That is what is impacting those companies. Buying leverage, your interest costs, your cost to borrow, a lot of that has moved significantly over the last 12 months, and that's hitting those stocks that are not related to the AI theme.
Yeah, that's a good point. And that was something that, you know, kind of looking at the economic backdrop. I'm glad that you mentioned that because it's something actually Pete and I talked about last call. But also, you know, it's the question of, is Fed policy having an impact? And if so, you know, kind of what are the lags of it? And, you know, based on kind of what we've seen, I guess, the stock market do, you know, there's been maybe some question about that. And, you know, I would probably say that through a lot of most cycles, we kind of get that, you know, there's maybe that doubt or that question, is this time different, initially in it. And I think that, if looking quick at the Fed, they held rates steady, was expected. Like you said, they're projecting one more. The markets have been kind of focusing here on their what they call their economic projections and their forecasts, which Powell downplayed, but they're expecting to cut rates less next year than what they did the prior quarter. So, the markets have been pricing in this higher for longer. And, it's kind of, I guess, my sense that while the labor market has been strong, and really it's kind of leading everything at this point. It always does, but this cycle seems to be even more. And we've got payrolls again this Friday. We'll get the updated read there, but reasonable growth is projected. We still have services demand holding up pretty well. Randy, earlier you mentioned kind of the revenge spending and travel, but that continues to hold up. Manufacturing is probably the weakest area, but my sense is that I think we're seeing just kind of a gradual softening in the economy as the Fed's tightening and policy changes are filtering its way through, and also along with that, the pent-up savings and demand from consumers and corporations are being worked off. There was certainly a lot there from prior stimulus, and that is taking some time for it to be worked through. But with I would say along with the AI theme, it's interest rates and yields over the last month or two have certainly been one of the probably bigger themes that investors have been looking at. And I guess I wanted to touch on that for a minute because that is a question we get a fair amount, and kind of what's behind this recent move. And I mentioned the Fed and kind of the higher for longer, but at the risk of getting a little too wonky, the markets are pricing in a higher term premium. At least that's kind of behind this most recent move. And probably really kind of think of it as more like a bond risk premium. It's kind of similar to the equity risk premium for just broad pricing of risk in markets. It's separate from things like credit risk, but really it's kind of more about economic and inflation uncertainty, future issuance, those kind of things. And I think with markets repricing with Fed expectations, and also the expectation that the quantitative tightening program is going to be ongoing for some time, and then finally just the current fiscal backdrop has kind of driven this move. Taking a step back, really, treasuries are seen as the safe haven asset in a flight to quality. We don't think that's changed, and that's going to pose limits on the repricing of term premium. But one adage that comes to mind kind of in this is that yields and rates take the escalator up and the elevator down. We saw that with Silicon Valley Bank and that area, that those related banks in March. And kind of tying this back to what we started talking about here, Randy, is that higher yields filtering through the economy will tend to slow it down. We think maybe the effects could be a little more prolonged this cycle. Although if you look at prior cycles, we're we've actually been following it in a pretty reasonable average type manner. But these are the kind of things, as it filters through, as the economy we expect it to slow, that does build support for fixed income. and at some point it kind of the process becomes self-limiting in our view of that.
Yeah, and just to touch on, so, bringing that to the equity markets, where are we today, given yields on the 10-year at 4.75, given that maybe 3 months ago, the thought was that you may get a rate cut in 2023, although we never really subscribed to that belief. Where are we at the S&P at 4,200, down 5% for the month of September? If I step back, in when we did our July webinar, that was around the peak of the market, we said there was more risk, or the risk reward skew was more neutral to negative. I'd say it's now moved to neutral. There's pockets of definitely some attractive stocks. In fact, some of them are in the semiconductor space. A lot of those names have sold off 20 to 25% in the last month or so. They're more related to the automotive end market, and I think that the strike notwithstanding that potentially could happen, the automotive, given the content growth, safety components, and more cameras, more sensors, more just overall technology that is in the cockpit of a car, and as you get the EV mix, which has 4 to 10x the amount of semiconductor content, that segment definitely has a nice outlook, and the stocks have now pulled back significantly, so there's some opportunity, we think, there. The rates are definitely impacting REITs and utilities. Those are always were bond proxies when you couldn't get yield in the fixed income markets. Don't forget 10-year sat around 2% or under most of the last decade. Weren't getting much yield there, so you went into the utilities, you went into the REITs. Those have sold off aggressively in the last month because rates have popped a little bit here, or over 4, and have sustained that for a bit. So healthcare is another sector that has had a yield component to it, because it had a little bit of lower growth, especially for the pharmaceutical names. But those have definitely got into the cheap area, and some of that has to do with some of the drugs Eli Lilly and Novo Nordisk make that focused on weight loss. And the thought is that, well, if people are healthier and less obese, or less weight issues, that could take away some of the procedures that happen for every other knees, hips, and just kind of services, which would be great. But I don't think that the weight loss drug is going to be the panacea that is maybe being priced into it. We'll see. But the market is creating opportunities always. And a year ago, the 10-year was at 4.25. It's at 4.75 today, and the S&P was at 3,600, at 4,200. But a year ago, the thought was that the recession was hitting soon, and earnings would be really down in 2023. That didn't happen. Earnings are going to potentially be up in 2023, overall aggregate for S&P versus 2019. So this lag effect, as you mentioned in your discussion, it still hasn't hit yet. It's slowing the economy, but certain segments of the economy slowed last year and are actually improving this year. Remember Nike and Target, even though Target stock is significantly down still, they had inventory issues, which everyone was going more services than goods. Well, that's cycled through. The goods inventory has now cleared the channel. It's now actually at a positive in terms of where it was a year ago. So that's recovered. You've had PC demand bottom. You've had smartphone demand bottom. You've had China bottom in a lot of the technology spending segments. So there are some risks to certain parts of the economy, but some other parts of the economy have gone through that recovery over the last 12 months. So again, it's very difficult market to forecast what the next 6 to 12 months will be. It always is. No one ever knows. All we're trying to do in the strategies, whether it's equity income to core, to international, defensive equity, or value, those are the funds I'm responsible for, is just be balanced, in that we don't get caught with any one bet that could overwhelm the performance of the strategy, and just have patience, because the markets moves can be very violent in a short period of time, and then they kind of self-correct again. So rates at 4.75 today, who's to say in 2 months they're not back to 4.25? I don't know. Maybe they're higher, maybe they're lower. But again, the patience and balance and the diversification in the strategies is how we're running it and how we think is best, both to preserve capital, but also have the outlook for growth. If you're investing in a core or international strategy, you know, it's not about just capital preservation. It's about adding that growth component to the overall portfolio, so you have a diversified portfolio along with your fixed income and your other assets in your portfolio. So that's just a little color on what I'm thinking, Jeff, about the markets here, given what's happened over the summer and the rates.
Yeah, appreciate that, Randy. Certainly, plenty of cross currents, and the cycle always plays out a little, obviously, differently than what one expects. I think coming into this, the rapid moves with COVID, and then the rapid rate hikes that the Fed had last year, the kind of expectation was that was going to bite very quickly, and I was in the camp that it would probably hit more quickly than longer. So willing to admit that, but it does seem like maybe at this point we're getting there's been a few curveballs thrown at us from, let's say, the fiscal side and other sides that have helped to draw things out a bit, but again, watching where the fundamentals are taking us, and then I like your point of just trying to balance those risks in the strategies and portfolios, given where we're at with the cross currents.
Yeah, again, the one segment we haven't talked about is housing. I mean, the supply is at all-time lows in terms of inventory on the market for secondary housing, and the problem with the interest rate environment currently is who's going to move, who's going to trade a 7.5% mortgage for a 3 and under, or 3.25, or somewhere around that, I think, is the average mortgage rate at the moment. So that's the one area of the market that is just dead on arrival. I mean, there is very little transactions happening. Prices have not corrected because there's no inventory. And again, there's no impetus to move because you're almost locked in to the house you bought at the 3, because who's going to go trade your mortgage to 7? So that's the one area of the market that I don't know how it corrects itself, other than inflation gets under control, or the 2% target, or whatever range we want to use over the next 6 to 12 months, and rates start to reflect that we are going to soft land, and they probably go down from here rather than up. Again, that's probably not the consensus call today, but then that would help with the 30-year. If the 30-year can get back to 5 on the mortgage rate, then I think that can help with the inventory situation, help with people move, because the 3 to 5 trade-off, if you need a bigger house, you got to move, that trade-off is easy to absorb than the 3 to 7.5. So that's the one area of the market that I just don't know how it's going to correct itself. It's very puzzling. It's never been like this. It's always been the other way. Rates get cut, right?
Well, certainly for the last, roughly 40 years. It's, the argument of, Fed hikes, will there be an impact? That's certainly where we saw it first, and probably, have had the longest lasting effects here. And, it's, in my mind, made that, more of kind of a pushing toward, new housing type supply, because of what you mentioned, with existing homes, people being more reluctant to sell,
right?
Unless it's they have a particular real need to, or relocation or whatever. So
So as we stand here today, Jeff, give us your base case on the 10-year by, do you think we continue to move higher or, not that we can call anything, because you'll turn around and ask me where the market's gonna go, but just
Yeah,
kind
Randy, what's your base case on the S&P? Can you
of,
tell
all
me
right,
that?
well, you answer first. I hadn't finished my question. So base case on the 10-year, we're at 475 at the October call. What do you think?
Yeah, it's crystal ball's cloudy. I think I'll kind of go back to my comments and then, what are we doing with strategies is that the move-in rates does become self-limiting. And it slows the economy. The other thing that I didn't really touch on is that things can break. A lot of times you see it, of course, every cycle is different, but is it in potentially emerging markets, let's say, a country has a lot of dollar denominated debt, they're trying to refinance it. And is that kind of a quote shock to the system? So there's kind of multiple avenues how that can play out. But what we're as fixed income investors, we like higher yields and we want to put money to work. So the key there again with the strategies is having that balanced, diversified approach, which is what we're doing in fixed income. And as we have cash to work, put to work, particularly new portfolios, it's legging into it. So that's kind of what our approach has been on that. There's plenty of technical levels. Do we hit a certain level? There is a little bit of a sense in markets that some people are kind of standing back and letting this play out. And again, you hit a particular level or threshold that a shock comes through and then it can reprice. Not saying it's certainly going to happen, but that's what we tend to see a fair amount, that the escalator up and the elevator down.
Yeah.
But
it'd be interesting to see banks quarterly results because rates have significantly moved. So some of the issues that popped up in early March, maybe we're not done with that, although Fed has set up some facilities to help alleviate the mark to market pricing you have to do on some of those securities. They've helped set up a system to prevent what kind of happened to Silicon Valley and Signature Bank. So, but that issue hasn't gone away. So it'll be interesting to see.
yeah, that's a good point. We seem like we got through it. It seems like that Fed liquidity facility is kind of got us through it, but we're still some financials, their deposits are still kind of gravitating toward the money markets. Over time banks are having to increase yields on deposits to maintain them, and then as the credit cycle, it's still currently in good shape, but you start to see as some sectors weaken, how does that filter through? And those are certainly the things we're on the lookout for, as things slow down and particular sectors can feel the effects more acutely than others. All right. At this point, checked with Vicky. We don't have any questions, so we're going to go ahead and conclude today's call. Please join us next month on Tuesday, November 7th at 12 p.m. Eastern. Thank you, everyone, for joining us today, and we hope that you have a great rest of your week.